Dear clients and investors, while January and most of February felt like an extension of 2020, there is an increasing rise in the hope and optimism that has crept in amongst people as we start going into March. This message is aimed at providing you with an update of where the world and South Africa finds itself from an economic and investment market perspective. Let us start off by looking at the latest quarterly update from the International Monetary Fund, which was released in January this year. So we've had a decline in economic activity of about 3.5% in 2020, and the forecast is for an economic recovery of about 5.5% for the global economy this year, followed by 4.2% of growth in 2022. Most of the growth expected for this year will be coming from the emerging markets and developing economies, which is expected to grow by about 6.3%, while the advanced economies are expected to really grow by around 4.3% this year. If we look at the average rate that we've seen in the last 30 odd years for the global economy, the expectation is that the next 2 years will see above average growth for the global economy, slightly above the 3.1% average over the past 30 years. If we look at specific countries, then we'll see that the US, after a decline of also about 3.5% in 2020, is expected to recover by about 5.1% in 2021, and then for the European Union to recover by about 4.2% this year, while the UK will be coming off a very low base after a contraction of about 10% in their economic activity in 2020 to recover by about 4.5% this year. And then China, the expectation there is for growth of around 8.1% in 2021 and 5.6% the year thereafter. But there's a lot of certainty that's crept into the markets since the end of last year. First of all, we've had the US elections, which was received pretty well by the global equity markets. We're also getting very close now to the final approval of an additional fiscal stimulus by the US Senate of about $1.9 trillion. Under the Biden administration, the US-China trade relationship is expected to improve. We had Brexit at the end of 2020 without any major fallout. The second and even third waves of COVID infections are starting to decline while economies are being unlocked. So basically, the V-shaped recovery is becoming more of a reality for many countries. And last but not least, we've got the vaccines, which are being rolled out globally at an increasing rate. So in the US, we've had Mr. Trump leaving, but not without a fight. And the world generally expects Mr. Biden to have a better administration in terms of relationships with China and the rest of the world, and also addressing some of the division that was caused under the Trump administration amongst the US population. When we look at the decline in the latest trends for the global COVID-19 cases, it is showing quite a positive sign, and that together with the rollout of the vaccines is starting to play into the story of a global economic recovery. So if we then look at the US infections rate, and the US have been leading the COVID cases around the world, we'll see that the third wave already of these infections have started coming down quite significantly. So currently we've got the race for the vaccine around the world, with many countries trying to procure as many doses as possible of the vaccine for their people. If we look at the US vaccinations, we know that Mr. Biden has got a target of 100 million vaccinations in the first 100 days in office. And it seems like he is going to get to that target quite possibly. If we then look at the monetary stimulus scenario around the world, global interest rates still very low, still at historic lows, and expected to remain low for the rest of this year, which bodes well for the fact that while government debt is rising and has gone above 100% for many of the advanced economies, low interest rates as well as a global economic recovery will help them to be able to actually service that debt and to finally contain it and reduce that debt over time. Looking at the South African economy, we've also seen a steep decline in the second wave of COVID infections, and while we are still on a level 3 lockdown, the expectation is that we will be coming back to level 2 most probably in the very near future. We finally had the day where the vaccines have arrived. Unfortunately, we had a bit of a setback around the AstraZeneca vaccine, but we know now that the Johnson & Johnson and Pfizer vaccines are on its way, and some are already being rolled out in terms of the health workers specifically at this point in time. We know that about 40 million doses of the vaccine has been ordered by the government. So the next challenge basically is about the rolling out of these vaccines. And we know it's starting with health workers, then the frontline workers, and then the elderly and vulnerable, and then over to the general population, until we hopefully, towards the end of this year, reach a point of herd immunity. Looking at our economy, we know that it's been a declining trend since 2011. So as we went into level 5 lockdown in the second quarter of last year, we always knew that the result was not going to be good. So we had an annualized decline in economic activity of around 56% during the second quarter of last year. And then of that very low base, as the economy started opening up, we then had a recovery of about 66% annualized. That unfortunately still leaves us slightly below the economic activity levels that we had pre-COVID. One of the concerns that remain is the lack of fixed investment, which remains at 13-year lows. And it's specifically the private sector that keeps on making the necessary investments in the economy, but that is not sufficient to grow our capacity. And if we look at where South Africa finds themselves in terms of fixed investment spending, then we're finding ourselves basically lumped together with Brazil and Argentina, which is really not showing great growth at this point in time, whereas countries like China, India, Ethiopia, Tanzania, with their higher fixed investment spending, are showing much higher economic growth activity. We still have Eskom as a potential concern that might hold back the recovery in the local economy, and we know that Eskom is currently producing less than the power that they produced in 2004. So hopefully we'll find that government will also be looking at alternative energy resources more going forward. While the planned outages by Eskom has been coming down, unfortunately the unplanned outages has been going up, which pretty much leaves us in the same place where we're not sure about the production of electricity and the supply of electricity. So with the last Monetary Policy Committee in January, the South African Reserve Bank now expects South Africa to have seen a decline of 7.1% in economic growth last year, and they see a recovery of 3.6% this year, and then followed by 2.4% and 2.5% in the years thereafter, which means that we will most probably take about 3 to 4 years until we get back to similar economic activity levels as where we were pre-COVID. Unemployment remains a very sticky issue, and unemployment, the formal rate of unemployment, has now gone up to 32.5% for the fourth quarter of 2020, while the unofficial unemployment, the more expanded definition of unemployment, is actually sitting at 42.6 million people, with a big concern being the fact that of the people aged between 15 and 35, 3.1 million of that 10.3 million people are actually without employment, without education or any training at this point in time. Looking at the budget we had on 24 February, first of all, it was finding a vaccine to counter the deteriorating health of South Africa's economy and fiscal position. The budget was all about consumption, investing and infrastructure development, where the key themes were there to try and see how we can support the reconstruction and development plan for South Africa. A budget was presented with little room for error, and the risk of the government losing some credibility if they make any missteps is still large. Additional revenue of about 100 billion rand is going to be applied for tax relief and debt reduction, and government is also holding the line on public wages of about 300 billion rand in savings over the next 3 years, which is a very positive sign in terms of being able to make the tough decisions. The increasing inclusion of the private sector was also a welcome change in approach. The blueprint is there, but the question remains, is the necessary political will, collective alignment between all the parties and the leadership there to make it all happen. In terms of our government debt to GDP, while the expectation is that it will reach a peak of around 89.9% in the 2025-2026 fiscal year, which is slightly better than what the projection was of 95% in the medium-term budget in October. On the positive side, corporate taxes, VAT, those recoveries are actually showing quite a bit of an uptick. So That's also where the additional 100 billion rand of revenue came from in the last fiscal year. The Purchasing Managing Index, which is a leading indicator, is also starting to show signs of improvement, which means that manufacturers are starting to buy more raw materials. We're also coming off a low base in terms of business confidence, but business confidence and consumer confidence is starting to recover pretty well. Our trade balance has also been showing a positive balance in the last few months, and that is largely a result of the fact that our export prices, as a result of higher commodity prices and a weaker rand, is basically supporting the trade balance, which is playing in favor also of the rand. An additional factor supporting the rand is the fact that foreign investors have actually started investing on a net inflow basis in our bond market in the last few months. And that is basically the result of a little bit more optimism globally and more of a risk appetite for emerging market assets. The rand has also been showing strength as a result of the fact that commodity prices have been ticking up quite strongly, and there's a very high correlation between higher commodity prices and a stronger rand. This basically also helps us to see a little bit more clearly where inflation might be going. We know that oil prices are picking up, which will put some pressure on inflation, but a stronger rand should counter some of that. And we expect that the inflation rate will be around about the 4.5% number for the next year or two, which is pretty much in the middle of the 3 to 6% target range of the Reserve Bank, which means that it gives the Reserve Bank more space to keep interest rates longer at the current historic low levels. Moving along to the investment markets, we had a very strong recovery in global markets over the past year. Specifically over the past 3 months to the end of January, we've seen a 16.5% return on the global equity market in dollars. And over 3 years, we've had around about an 8.9% return from the global equity markets. If we look at where we were basically on the 23rd of March last year, at the height of the COVID pandemic and the big sell-off of about 34% of the global equity market in a short space of time, we have since recovered more than 80% from those levels in dollar terms. Most of this recovery has been as a result of revaluation, which means that it wasn't really about earnings. It was more about positive sentiment. But as we go forward, we do expect that earnings will recover as the global economy recovers, and that will start supporting valuation levels. It's also very important to note that while there might be some areas of the global equity market, specifically information technology, that is showing signs of a bubble, there are many areas of the global equity market that is still showing reasonable value. Looking at our South African market, over the past year to the end of January, we've seen a return of 14.5% from the JSE, some of the best returns we've seen in a long time from the local equity market. Listed property remained under a lot of pressure, down by about 35% over the past year. And then local bonds being the best performing asset class over 1 year, 3 years, and 5 years, while equity then shows up as the best performing asset class over 10 years still. The same for the South African market as we've seen in the global equity market. We had about a 35% sell-off in the period February to March last year. When we turned at around about 23 March, we then had a recovery of also about 80% in our local equity market. But once again, largely driven by a few stocks: Anglo's, BHP Billiton, Richemont, Naspers, the 4 main contributors to where our market has been going in the last 5 years actually. So again, many parts of our local market that is still showing decent value and that has not really recovered. If we look at the South African market, stock market, and we look at the fact that the rand hedge characteristics of our market, we know that about 65% of all the earnings of companies on our market is coming from offshore. So we've got a 65% Aussie rand hedge component in our market, and of that 65%, Naspers, BHP, Richemont, and Anglo makes up about 50% of that weighting. And we know then that those companies are very much aligned with what happens in the Chinese economy, which, as I said earlier, is expected to grow by 8%. So there still might be some decent growth to come from some of those stocks. One concern is the fact that our delistings continue. So we've had 250 companies that has delisted since 2001. So we're now sitting with listed companies of about just under 350 companies for local asset managers to select from. If we look at the local bond market, there are still real return opportunities on the bond market. The difference between the 3 and 10-year bonds haven't been this much basically in the last 30 years. And also if we look at the real returns, often on your 10-year and longer bonds, you're still looking at a CPI plus 5, 6 or 7% return. Last but not least, the Rand. The Rand has recovered by about 25% from its weakest level in April last year, when it was about 19 Rand 35 to the dollar. And now at 14 Rand 50, it is possibly reached quite a bit of a level where we expect it to stabilize. And the main reasons for why we've seen the better or stronger Rand is the higher commodity prices, as mentioned earlier, the weaker US dollar as a result of all the stimulus that the Fed is basically putting into the market, increased risk appetite amongst global investors, and then also the fact that we're offering really attractive real interest rates on our bond market. So looking ahead for the world, the current focus remains on the global COVID infection rates, vaccination rollouts, additional fiscal stimulus by central banks, and the opening up and recovery in the global economy. 2021 is expected to be a year of great economic recovery, albeit from a low base. Markets look ahead and has basically processed and discounted much of the good news when we look at recovery in markets, but there are still various areas in the global and local equity markets that still need to recover, and in addition, very attractive real yields on offer in the SA bond market. I look forward to providing you with an update soon. Keep well until then.